welcome. This is your special focus with me, Respect. In our special focus, we look at Fbc H, a financial services group controlling 6 subsidiaries. The operating SBUs are adequately capitalized to regulatory requirements. And in the half year, all the SBUs turned out profitable. To put perspective, the group has increased its profitability at a constant average growth rate of 70%, from 2 million in 2010 to 18.9 million as of 2015. With an interim profit of 9.3 million, FBC Holdings is in line to achieve a better profitability at full year compared to last year. The banking group's balance sheet has grown by 244% since 2009, from 167 million in 2009 to 574.6 million as at half year. The assets growth has been spurred by a growth in deposits from 94 million to 436 million by half year. In HY 2016, the banking group achieved an operating cash flow of 56 million, which is the highest ever in its history. Its model has been gradually skewing towards safer banking as it adopted a conservative approach to lending, cautiously treading the tight Zim operating terrain. As a result, NPLs have come off to levels below the targeted 10%. All the group's units are adequately capitalized and in line to meet the 2020 capital requirements by RBZ.
We have achieved a situation where we are actually recapitalizing the bank by more than 10 million every year. In 2014, we recapitalized by about $12 million, and in 2015, again, almost the same, similar amount, and we see the same trend happening in 2016.
We believe Fbc H raises the bar in a worsening environment where most are getting away on a tight environment card. We caught up with the executive management just after the results released to give us perspective to their performance.
The growth in interest income was mainly driven by our control of cost of funding, and it was also as a result of improved mix of the composition of our loans, where we had more loans which were actually yielding better than what we had previous year.
Fee and commission income recorded a spike against the CE's own predictions. We let the team give us their perspective.
Income line, as John has explained in his analyst presentation, is mainly because of volume of transactions, which actually increased significantly. As we have said, because of the shortage of cash, most of our customers are now going towards electronic payment system, and we've actually seen almost a 3-4-fold increase in the volume of electronic transactions.
RBZ has set a 2020 target of 5% NPLs, and this has led banks to become more conservative in lending even as interest rates came down. We asked if this target ratio was attainable against a worsening trading environment.
If you look at the total impairment allowance that we have, and you look at the grade 8 to 10, which is the NPLs, if we want them, we can write off everything and recover off balance sheet. And so that's one of the strategies we are going to employ.
We are in making sure that we recover from those customers who owe us, and where some customers are actually wanting more time to pay us, we are also to some extent restructuring those loans so that at least we are giving them loans which are according to their cash flows which they are generating. We are also, in terms of provisioning, if you look at our provisioning, we've actually made a huge impairment which we've got within the balance sheet. That impairment, we want to write off some of the loan.
We challenged John to demonstrate how they are going to achieve the targeted capital level of 100 million by 2020, given the dip in the operating environment and pressure on margins either in funded and non-funded income.
We have other SBUs which have already complied with the minimum capital requirements for their sector of business. And any profit that they are making, we have a deliberate dividend policy where at least 1/3 of the profits they are making will be declared as a dividend to Fbc Holdings. And after paying out a dividend to our shareholders, whatever remains will be channeled into FBC Bank.
Banks reporting for the first half have showed that in the main, deposits came off on the comparable period, and this is partly attributable to the panic withdrawals as liquidity challenges became more pronounced. On the contrary, FBC was one bank which recorded a gain in deposits. FBCH took us into this important liquidity aggregate.
First of all, the nature of our client base. If you have clients, for example, who are heavy into importing, it means they must put aside cash resources so that when they are eventually allocated foreign exchange, you just debit the account and make the remittance. So that money is there, sitting, waiting for the day foreign exchange is allocated to them. Then secondly, you must also look at the FBC brand. We have invested a lot of money in the FBC brand to an extent where there isn't much difference now between FBC as a local indigenous bank and any of the multinational or regional banks that are in this country. In terms of risk profile, we are now almost in the same league. And when that happens, the confidence of customers in bringing their deposits to FBC Bank is somewhat enhanced. Also, if you look at FBC historically, banks have been through all sorts of problems, but never throughout the life of FBC have you ever read a story where FBC has been sanctioned by the authorities or has done something outside the ordinary. Compliance is a big issue when it comes to FBC.
The outlier in FBC's performance was the mortgage business, which management, however, says was as a result of technical issue with the taxman.
The reason why the bottom line went down was because of a tax provision that we made in respect of capital gains tax. And as I explained in the analyst briefing, this is an issue which we are assisted with ZIMRA in an effort to determine exactly how we arrive at the cost of constructing a unit, because there are certain costs that ZIMRA would want to disallow, that which we think are an integral part of the cost of constructing a unit.
Close to the end of the interview, I brought back the fancied treasury bills concern, which John and Trinos attended to. They both concurred that the sovereign paper was a safer investment, a view shared by almost all top bankers I've had a chat with.
Our exposure as FBC to treasury bills is about $80 million, which we think is reasonable given our balance sheet of over $500 million. And secondly, I must put it on record that we have not had a case of the government defaulting on a treasury bill when it matures. In our dealings in treasury bills, we have a deliberate strategy. And that strategy is that we don't go long term. We mostly concentrate on those treasury bills that are maturing within a 365-day horizon, so that we can monitor the situation as it happens. And so far, I think our strategy has worked.
You also got an advantage of the treasury bill yielding a return. While if you've got just an RTGS balance, it's an RTGS balance which doesn't have any yield with the same risk profile. So you can actually note that from there, it's not as risky as people purport it to be.
FBC supported the asset class. In concluding, John helped us traverse FBC's future with particular focus on future growth prospects.
If you are looking at the bank, we are looking at focusing more on the SME market, because we see growth in that area. And you will see that whatever we are going to do is going to focus heavily on that area. If you look at the building society, the model that we have where we are constructing houses, selling them on mortgage, having a developmental profit as well as interest income is a model that we want to continue. If you look at the insurance, the business is shifting more towards micro insurance. When you look at the reinsurance business, we want to expand our scope, and this is why we have started the life business. So we are now doing short-term reinsurance and life reassurance. If you look at the microfinance business, again, this is precisely the area we want to focus on, especially, as I said earlier on, in the bank, because that is an area of growth. People have said in the past that people in the rural areas cannot be financed, but if you come up with appropriate structures where whatever they are producing, if they are farmers, has got an off-taker, and you have a deduct source arrangement after they deliver. And you put in place structures within the community, such as group lending, group joint guarantees. I think you can run a successful microfinance business. The stockbroking business, we've started courting the diaspora market, because people in the diaspora are Zimbabweans who would want to invest back home. And one of the areas of investment they can embark on is investing on the stock exchange. And if we can have a real-time link with them, where they can place an order, we'll be able to buy shares for them and confirm that they have been bought. We can again create a market that is currently not there.
In Forecast, it is our view that FBCH will withstand the economic pressure currently prevailing and the sectoral vagaries to maintain increased profitability. The fee and commission income line, which recorded a sharp spike, will however moderate going into 2017. We applaud the increase in dividend payout, especially where the share price is less responsive, though future dividends up to 2020 are likely to be dragged by the need to beat the 2020 capital target for the bank. For Equity Access, I'm Respect.